Top economist reveals U.S. stock market future outlook. In a dramatic turnaround on April 9, 2025, markets experienced one of their best single-day performances in history when the administration announced a 90-day tariff pause for most countries, with a notable exception being China. As you know, the U.S. stock market is currently experiencing unprecedented volatility, with recent developments indicating a complex and challenging period ahead. After witnessing historic drops followed by dramatic rebounds, Wall Street is grappling with inflation concerns, interest rate policies, and widespread uncertainty stemming from significant policy changes. This comprehensive analysis explores the current state of the U.S. stock market, key economic indicators influencing its trajectory, and the prognosis from top economists for the remainder of 2025 and beyond. Current state of the U.S. stock market, a volatile landscape. The U.S. stock market has entered 2025 facing considerable turbulence. After reaching all-time highs in February, with the S&P 500 touching 6,147 points, investors were jolted by a sudden market correction that threatened to evolve into a full-fledged bear market. Between February and April 2025, the S&P 500 witnessed a dramatic decline of nearly 19%. Wiping out approximately $5.83 trillion in market value within days after President Trump's announcement of sweeping tariffs on global imports. S&P 500 chart showing recent market volatility. The S&P 500 lost approximately $5 trillion in 2 days following Trump's tariff announcements before a dramatic recovery. Reuters. However, in a dramatic turnaround on April 9, 2025, markets experienced one of their best single-day performances in history when the administration announced a 90-day tariff pause for most countries, with a notable exception being China. The S&P 500 surged 9.5%, marking its most significant one-day increase since October 2008, while the Dow Jones Industrial Average jumped 7.9%, 2,963 points, and the Nasdaq soared by an astonishing 12.2%. Despite this recovery, the S&P 500 remains approximately 11% below its February peak, highlighting the continued uncertainty plaguing the markets. This volatility underscores the unprecedented sensitivity of today's markets to policy decisions and global economic trends. Macroeconomic factors shaping the market outlook. Inflation and interest rate dynamics. The Federal Reserve's approach to monetary policy continues to be a pivotal factor influencing market behavior. After initiating a rate-cutting cycle in late 2024, the Fed has adjusted its stance in response to persistent inflation pressures. According to Deloitte's United States Economic Forecast for Q1 2025, Consumer Price Index (CPI), inflation remains stubbornly high at 2.8% for 2025, well above the Fed's target. Jay Berry, head of global rate strategy at J.P. Morgan, projects the Fed to slow down the pace of easing to a quarterly pace, and look for 100 basis points of total easing such that the Fed funds target range reaches 3.5% to 3.75% by the third quarter of next year. This modest easing stands in contrast to more aggressive rate cut expectations that prevailed earlier. The persistence of inflation has prompted the Federal Reserve to adopt a cautious approach to rate cuts, with market expectations now suggesting 100 basis points of cuts throughout 2025, significantly less than anticipated at the beginning of the year. This recalibration has been influenced by resurgent inflation concerns due to tariff impacts. Elevated year-ahead inflation expectations, rising from 3.3% in January to 4.3% in February 2025. Strong consumer spending in early 2025 despite inflation fears. Trade policy and tariff implications. The introduction of sweeping tariffs has emerged as a significant market disruptor in 2025. The initial announcement of reciprocal tariffs targeting multiple countries sent shockwaves through global markets, with particular concern over the 104% duties imposed on Chinese goods. After widespread market turmoil, a partial 90-day pause was announced, though the enhanced 125% tariffs on Chinese imports remain in place. Bruce Kasman, chief economist at J.P. Morgan, notes that efforts we think the U.S. administration is going to take on trade is likely to be one that will raise global inflation next year, limit room for central bank easing. This perspective aligns with growing concerns that tariffs will increase consumer prices for imported goods, disrupt global supply chains, potentially trigger retaliatory measures from trading partners, add inflationary pressure that could limit the Fed's ability to cut rates. Federal Reserve Chair Jerome Powell has warned that the tariffs will likely increase inflation, potentially forcing the central bank to maintain higher interest rates for a more extended period than previously anticipated. GDP growth projections. Economists have been rapidly revising their growth forecasts downward in response to policy changes and market reactions. Deloitte's baseline scenario still projects real GDP growth of 2.6% in 2025 and 2.1% in 2026, with growth averaging 1.9% per year over the subsequent 3 years. However, more pessimistic forecasts have emerged from major financial institutions. Goldman Sachs has cut its 2025 growth forecast for the U.S. economy to just 1.7%, down from 2.4%. Morgan Stanley has reduced its growth expectations for 2025. J.P. Morgan suggests growth will remain around 2% for 2025, but with increased downside risks. As a point of comparison, Deloitte's more pessimistic trade wars and persistent inflation scenario projects economic growth slowing considerably to 2.2% in 2025 and further declining to 1.3% in 2026. Recession risk assessment, growing concerns. Perhaps the most significant shift in economic outlook has been the dramatic increase in recession probability assessments from leading financial institutions. J.P. Morgan has raised its recession odds to 60%, up from 40%, while Goldman Sachs has increased its recession probability estimate to 45%. S&P 500 recovery after Trump's tariff pause. The market's dramatic recovery following the announcement of tariff pause. Investopedia. Recession risk assessment, growing concerns. Perhaps the most significant shift in economic outlook has been the dramatic increase in recession probability assessments from leading financial institutions. J.P. Morgan has raised its recession odds to 60%, up from 40%, while Goldman Sachs has increased its recession probability estimate to 45%. S&P 500 recovery after Trump's tariff pause. The market's dramatic recovery following the announcement of tariff pause. Investopedia. This reassessment reflects growing concerns about tariff-induced economic drag. Increased costs for businesses and consumers are expected to dampen economic activity. Business confidence erosion. Uncertainty regarding future trade policies is causing businesses to delay investment decisions. Consumer spending constraints. Higher prices for imported goods could limit consumer spending power. Global growth slowdown. Retaliatory tariffs and trade disruptions are likely to impact global economic growth. According to HSBC analysis, equity markets are already pricing in approximately a 40% chance of recession by the end of 2025, suggesting that some of this risk has been factored into current valuations. Sector-specific outlooks. The impact of current economic conditions varies considerably across different market sectors. Technology sector. Despite broad market volatility, the technology sector continues to show resilience, particularly in areas related to artificial intelligence, AI, and semiconductors. During the April 9th market recovery, tech stocks led the rally, with Nvidia jumping 18.7% and Apple surging more than 15%. Dubravko Lakos-Bujas, head of global market strategy at J.P. Morgan, observes that the AI cycle and the AI investment thesis is something that has the potential for further broadening out as we go through 2025. And it's very much so a U.S. story. Top tech stocks that analysts are recommending for 2025 include 1. ARM Holdings, 2. CrowdStrike, 3. Nvidia, 4. Broadcom, 5. Nintendo. The technology sector outlook for 2025 remains relatively strong, with projected IT spending growth of 9.3% globally, driven primarily by continued investments in data infrastructure, AI applications, and cloud computing. Consumer spending and retail. Real consumer spending has remained resilient thus far, with Deloitte reporting 4.2% growth in the fourth quarter of 2024. However, consumer confidence has begun to show signs of deterioration. The University of Michigan consumer sentiment fell 9.8% in February to 64.7, with all demographic segments showing declining confidence. For 2025, real consumer spending is projected to rise by 2.9% before slowing to 1.4% in 2026. Particularly vulnerable are durable goods spending, expected to slow to 0.8% growth in 2026. Retail sectors heavily dependent on imported goods. Businesses relying on price-sensitive consumers. Major retailers like Walmart have maintained their full-year sales guidance, but note that the range of outcomes has widened due to less favorable category mix and the desire to maintain flexibility to invest in price as tariffs are implemented. Financial sector. Banks and financial institutions face a mixed outlook. While higher interest rates typically benefit bank margins, economic uncertainty and recession risks could increase loan defaults and reduce lending activity. J.P. Morgan Chase, Goldman Sachs, and other major financial institutions have been adjusting their forecasts and business strategies in response to changing economic conditions. Stephen Dulake, co-head of fundamental research at J.P. Morgan, characterizes the credit market outlook as, quite frankly, not too different from where we were at this juncture last year looking into 2024, noting that the overall credit ecosystem in a global context remains pretty robust. Travel and transportation. The travel sector has shown particular vulnerability to economic uncertainty. Delta Airlines recently pulled its guidance for 2025, citing that, with broad economic uncertainty around global trade, growth has largely stalled. Airlines were among the largest gainers during the April 9th market recovery, with Delta soaring 23.4% and American Airlines gaining 22.6%, highlighting the sector's extreme sensitivity to trade policy developments. Regional market disparities. A key theme emerging for 2025 is increased regional divergence in market performance. According to J.P. Morgan's 2025 outlook, the world is moving away from common developments that have created synchronization effectively, the reverberations of the pandemic shock. And as those reverberations are now fading, we think you're going to see more divergence across countries. U.S. market exceptionalism. Despite global uncertainties, many economists continue to view U.S. markets as relatively better positioned than international counterparts. Dubravko Lakos-Bujas from J.P. Morgan states, "We think the U.S. exceptionalism story is something that likely will continue to power through. We think the U.S. remains the growth engine." Factors supporting this U.S. exceptionalism include business cycle that remains largely in expansion, robust technology sector leadership, relative economic resilience compared to other regions, ample liquidity in the broader system. Emerging markets challenge. Emerging markets face particular challenges in the current environment. Luis Ogans, head of global macro research at J.P. Morgan, notes that while emerging market inflation has been declining, projected at 2.8% for 2025, the effects of U.S. trade policies could disrupt this progress. Countries most vulnerable include China and export-dependent Asian economies, nations with high exposure to global supply chains, countries with significant dollar-denominated debt. Meera Chandan, co-head of global FX strategy at J.P. Morgan, projects that a 10% tariff can lead to euro to dollar testing parity in Q1 and expects $/CNH to reach the 7.50 type range, with upside risks if tariffs are higher. Stock market performance under the Trump administration. U.S. Bank investment strategies for the coming year. Given the complex and volatile market environment, investment strategists recommend several approaches for 2025. 1. Sector rotation and selection. With increasing dispersion between sectors, selective positioning becomes crucial. Sectors likely to outperform include technology, particularly AI and semiconductor companies; healthcare, which typically shows resilience during economic uncertainty; energy, depending on global commodity price trends. Sectors facing headwinds include consumer discretionary, particularly those dependent on imports; travel and leisure, due to reduced consumer confidence; Companies with significant exposure to trade-disrupted supply chains. 2. Fixed income opportunities. Jay Berry from J.P. Morgan suggests focusing on the front end of the yield curve for fixed income investments, noting that money markets are not fully pricing in our Fed forecast right now. He expects the 10-year Treasury yield to trough around 4.1% by next fall before reaching 4.25% at the end of 2025. This recommendation stems from observations that the front end appears relatively cheap given Fed communication patterns. Long-term yields may remain elevated due to term premium considerations. Treasury market demand dynamics are undergoing significant shifts. 3. Diversification across markets. Given regional divergences, geographic diversification becomes increasingly important. While U.S. equities remain favored, selective exposure to other markets can provide opportunities. Japan is viewed as the second derivative off of the U.S. and remains a positive story. European markets face both cyclical and secular headwinds. Emerging markets present selective opportunities, particularly commodity exporters. 4. Volatility management. With the CBOE Volatility Index, VIX, remaining elevated, recently hovering near 49 points, strategies to manage volatility will be essential. Increased cash allocations for flexibility. Option strategies to hedge downside risks. Phased investment approaches to avoid timing mistakes. Conclusion: navigating uncertainty. The U.S. stock market faces an exceptionally challenging and uncertain period as 2025 progresses. The significant volatility witnessed in recent months underscores the market's sensitivity to policy shifts, particularly regarding trade, fiscal measures, and monetary policy. While recession risks have undoubtedly increased, with top economists like those at J.P. Morgan now placing the probability at 60%, the outcome is far from predetermined. The administration's willingness to pause most tariffs demonstrates policy flexibility that could mitigate some downside scenarios. Investors should prepare for a period of heightened dispersion across sectors, regions, and asset classes, while maintaining diversification and focusing on companies with robust balance sheets and sustainable business models. The resilience of the U.S. economy remains a significant factor, but navigating the coming months will require careful analysis, strategic positioning, and a willingness to adapt to rapidly changing conditions. As J.P. Morgan's Bruce Kasman concludes, the risks lie in more extreme policies. If we see tariffs go up against the entire world, if we see geopolitical stress and conflict increase, we are in a situation where maybe the sentiment shock becomes broader and deeper and includes the United States and could be a threat to the global expansion next year. The coming months will reveal whether policy adjustments, market resilience, and economic adaptability can steer the U.S. economy and stock market through these turbulent waters or whether more significant corrections lie ahead. What remains certain is that 2025 will be remembered as one of the most volatile and consequential years for U.S. financial markets in recent history. Thanks for watching. Don't forget to subscribe, like, share.